What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benisaki and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started. All right, August, we're back. Actually, second show of the day.
And we warmed up. Huddle, team huddle. No, this is great. We have another guest, another exciting topic to discuss. And should we get right into it? Is there something else we want to quickly touch on? What's happening with the world? What's happening with the economy?
I just keep thinking about how many conferences we've been to lately.
Yes.
Like
yes,
the travel.
And we're going to two more, right?
Yeah, a couple more. Vegas conference coming up. We're speaking on a panel there about how to raise debt and equity in uncertain times. And there's another one coming up that we're going to right after that. And
in Phoenix. You're going to Phoenix, right? Like back to back.
That's right. And then there's the Investor Conference. Dan Hanford's having his conference. So there's all these things coming up. So
who's that? Dan Hanford? Oh, Dan Hanford. Got it. No, I'm just bugging. I'm just bugging with our good friend there, Dan Hanford. Now, so I mean, I was kind of talking about what's happening with the economy. We got some reports are saying there's 1 million apartment units coming to the market nationwide. So,
but I keep saying, that is pretty freaky for us multifamily owners.
Yes.
But there's also a shortage.
Yes.
There's also a massive shortage.
$6 million shortage.
Units.
But there's a lot of units coming to. So. All this means is that investors have to be much more cautious when they're underwriting deals. If you're buying a deal came to across my desk, 1950s built or 45. I'm like, hey, World War II was still happening when this deal was built. If you're looking at a 50s, 60s built product,
it's going to be hard for the competition.
It's grinding, and the rents are at, their forecasted rents are at $1,000, and a brand new build down the street is asking for $1,300. You might be very selective for sponsors, for LP investors, and all. Okay, let's get into our show. We're going to be talking about some great stuff. We're going to talk about how to use your retirement funds to invest in real estate, both passively and actively.
And a lot of people don't actually know that they can do this. So this is going to be really exciting. And today we are joined by Josh Plave. A little bit about Josh. Josh is an apartment owner and operator who specializes in helping investors use their retirement funds to passively invest. So very exciting topic. As a general partner on over 1,600 units across the country, Josh runs Wall to Main, where he provides education and investment opportunities structured specifically for IRAs, 401ks, and everything in between. So August and I believe this interview with Josh will bring great value to both passive and active investors looking to scale their investment portfolios by using IRAs and 401ks. Welcome to the show, Josh.
Thanks for having me, guys. I'm excited.
Welcome to the show, man.
Yeah, really excited to dive into things. But first off, maybe you could tell us about your background and then your start in real estate, please.
Yeah, absolutely. So the story kind of goes back to, and the reason I kind of talk about retirement accounts is it starts when I was 16 years old. I was working a summer job, just as any kind of teenager would. And my mother and my grandfather were both CPAs. So they, at the time, were very much advocates of looking out for my future and making sure that I was, going to build and take advantage of compounding growth. So I took I think it was $1,000 I made that summer. I took that and I put it into a Roth IRA. So I've actually had a Roth IRA since I was 16, and I've been growing it ever since. So fast forward about 10 years from then, and unfortunately, both my mother and my grandfather had passed away at that point. But what they were nice enough to do was to leave myself and my sisters with specifically their retirement accounts. So it wasn't like a life-changing amount of money, but it was enough that I really needed to make sure I was going to be a good steward of everything that they had worked for and stood away from themselves and then passed down to us. So that's kind of how I ended up in the retirement space. I needed to understand how I was going to, properly deploy the funds. I knew at that point, I really didn't want to I wasn't really trusting of the stock market as much. And I kind of wanted to figure out what alternate assets I can move it into. So I ended up learning about some self-directed funds, which we're going to jump into. But eventually that was kind of the same time that I was moving towards real estate, and I understood where I was able to deploy them. It then influenced the asset classes that I ultimately ended up becoming involved in on the active side myself as well. And that's kind of when I figured out all that information, and it really took me 2 or 3 years to find all of the information we're going to talk about today. So it took a long time, and I was realizing there's no one central place. So that's kind of why I started to build Wall to Main. I wanted to have a centralized place so people can learn about the topic and also find investments that are specifically aligned for a retirement account itself.
So it started out as a kind of a need, not a want, a situation that, you know, was put up on your shoulders, and then it was access to these funds through the retirement account funds. But then real estate was secondary. You could have invested into Wall Street products like index funds and what have you, but you looked at real estate. Was it initially passive options? Was it active options? What did you look at initially?
So it was kind of at the same time where I was starting to shift careers. I just happened to, at the same time, my company wanted to move me to halfway across the country. So they gave me some severance, and I had half a year to kind of figure out what I wanted to do and move into. So that's the same time I was kind of moving into real estate in general. And I mean, like a lot of people in real estate, I did the same thing where, you know, you start looking at all the different avenues you can go down. You're looking at flips, wholesaling, notes, lending. I mean, everything you can possibly think of. And I'm thinking maybe I'll do a little bit of this, I'll do some of this. But ultimately, I ended up in multifamily because I went to one of these conferences. I was living in Denver, Colorado at the time, and there was a conference there. And what ultimately ended up being my mentor, he showed up, he gave a presentation, and he was explaining to me that once you go past 4 doors and you enter the 5-door and up territory, it's automatically a commercial property, and the whole lending process is different. And in my mind, what I've now learned is that it's really just a question of how many zeros are at the end of the transaction, because you still have to go through all the same process, whether it's a 5-unit property or a 500-unit property. So I realized it was really just about scale, and there was more teams that I could rely upon, and it wasn't just up to me. And I was kind of, one of the fears I had with using retirement funds was, okay, I'm going to invest them into something that I'm running. Maybe if I don't have the background, I don't understand, I might blow the entire thing up. I might lose all the value in it. But I like the fact that multifamily had whole teams behind the investment that I could rely on their expertise, whatever their specific avenue was, and know my retirement funds were in better hands.
Not only multifamily, but syndicated multifamily deals. Awesome. And we'll get into the multifamily side of things, real estate side of things, investing side of things. But let's go kind of break down IRAs. You talked about Roth IRAs. Give us a crash course on, Ava, if you want to jump in.
Just quickly go through what an individual retirement account is, which is an IRA, and what a Roth IRA are. And just for all of our Canadians that are listening right now, this would be very similar to RRSP or TFSA. Yeah.
So essentially, an IRA is just a retirement vehicle. It's typically going to be not employer sponsored. There are a few, but the vast majority of IRA funds are not employee sponsored. It's probably something that you're going to be opening up yourself or rolling other funds into. Like if you've got a corporate 401k, you can roll that into an IRA when you leave that employer. It's a retirement vehicle that essentially is meant for you to use once you turn 59 and a half. That's the age that you can start taking funds out without any penalty. And the difference there's really kind of 2 different versions of the money that you can put into it. There's traditional, and that was the original form of an IRA. So the traditional IRA, and then the Roth IRA. And so traditional is going to be your pre-tax funds. So you can take a paycheck, and before the paycheck ever hits your account, you can deposit it into your IRA. So it's tax deferred up front, and then you can grow it tax deferred through the life of the IRA.
What percentage of it can you do that? What percentage of it?
Well, the IRAs themselves have contribution limits, which are $7,000 a year.
Got it.
Beyond that, you can roll over more funds than that. There's no limit to the rollover. So if you have a 401k, it's like $200,000 and you leave that employer, you can always roll that into an IRA if you'd like. But each year you can contribute up to 7,000. But yeah, so with traditional, you grow it tax-free for the life of the IRA. And when you take distributions at the end, which are basically you're pulling money out of the IRA, that's when you get taxed. So it's going to be counted as active income and it gets added to your total income for the year. With a Roth IRA, it's kind of reversed. So you get your paycheck, it comes to you, it lands in your bank account, you pay the taxes, and then the funds then go into the Roth account. So you're paying your taxes up front, then same vehicle, it grows tax deferred in the IRA. But when you go to take distributions and move funds out of the IRA, there's no taxes involved at all. You've already paid your taxes on the front end. The government used it to basically incentivize people to pay more taxes up front so they could have a larger tax base and give people the opportunity to grow it.
Got it. So it's Roth IRA. You use your post-tax funds to invest into this vehicle. It doesn't matter how large it grows. It's 100% tax-free.
Yep, exactly.
Got it.
Because you pay your taxes up front.
Cool.
Okay, Josh, I'm excited to learn more about, the unrelated business income tax, UBIT. So go ahead, first of all, explain what it is, and then feel free to get into cost segregation, straight line depreciation, custodian account versus checkbook IRA, and geek out on any other accounting lingo.
And maybe we can quickly go over this disclaimer here before Josh gets into all that fun
just
stuff.
Quick disclaimer, as always, everybody listening, we aren't qualified tax professionals, and we don't want to suggest that we're offering tax advice. So we just want to make sure you're aware of issues. You should be, if there are any issues, you should obviously be taking this up with your CPA. So always, of course, obtain independent legal and tax advice before trying any of this at home.
Yes. Awesome.
Yeah. So one of the key tenements behind using retirement funds to invest. The cool thing is retirement funds most people believe they have to be invested in the stock market. You've got your retirement account maybe at a Vanguard or a Schwab, Fidelity, these large banks, and they only offer stock products. So you can invest in anything you want. There's 3 limitations. You can't invest in collectibles like art, jewelry, and cars. You can't buy life insurance products, and you can't invest in an S corporation due to tax purposes. But outside of that, you can invest in anything you want. But the main tenet behind all of retirement investing is it has to be passive. You cannot use your funds to aid your active income. So you can buy, for example, an Airbnb, let's say, with your retirement funds. And let's say you buy it all cash. You can rent that out to anybody you want, but you can't rent it out for yourself because your current self is going to be benefiting from the actions of your retirement account. And then it's vice versa. You can't actually work on that house. So you can't go in and, change the toilet out. You can't work on the house at all because your retirement account would be benefiting from your active current day actions. So you kind of got to stay separated away from your retirement account. So because it needs to be passive, that's why I ultimately ended up choosing multifamily syndications, because they're a passive investment. And I like real estate in general. So it allowed me to kind of look for more opportunities. So when you end up in a syndication, obviously commercial properties, we're not buying things in all cash. So you're involving leverage, you're involving loans from an outside source. So essentially what's happening, let's say we buy a 100-unit property and we use 75% leverage. So 25% of the funds to buy the property are contributed by equity, and 75% of the funds are from an outside source. So in your example, if you're investing yourself $100,000, your $100,000 would go towards that 25% where you're providing the equity. But it's a tax deferred source. And now your tax deferred source of the retirement account is benefiting from a non-tax deferred source, which is a bank, a credit union, whatever it might be. And it's going to contribute funds into this investment and you're going to benefit from it. And the IRS is okay with that. They say it's fine, but there is a tax involved. And so what essentially happens is if we earn $100 on this property, and math, this is very rough math, but if we earn $100 on the property, $75 of it would be eligible for taxation because it was derived by an outside source, and 25% would still be tax deferred because it was earned by your IRA or your 401k. So what happens there is the taxable income is called unrelated debt financed income. It's UDFI. So you earn UDFI and ultimately you end up paying UBIT, which is unrelated business income tax. So you earn UDFI, you pay UBIT. But the nice thing about investing in commercial properties is there's a lot of losses that are involved. There's huge paper losses. Even if you're not actually losing on the property, you're probably in the first year or two going to be seeing a loss on your tax return for the deal itself. And so an IRA can actually make use of these depreciated losses. So you can use your portion. So basically, let's say you've invested $100,000. You might get back $50,000 in losses on the first year, we'll say. Of that 50, you can use 75% of that is eligible to be used, because in the same way 75% is eligible to be taxed, 75% of your losses are eligible to be used against that income. So you can actually use that proportional share of losses and interest expenses, operating expenses, all of that stuff to help to offset your UDFI, which helps minimize your UBIT. A little complicated, but the nice thing is you still benefit from that high loss, lowered tax situation that commercial real estate offers.
To demystify this a bit farther, right? Walk us through a journey. You have a high income earner. They have a retirement account, their IRA account. They connect with a sponsor or a private equity firm like yourself. There is a multifamily syndication investment they could invest as a limited partner. They transfer $100,000 from their retirement account into the deal as a limited partner. So that's their investment. They receive their limited partnership units. But in the first year, they get, let's hypothetically say they get $50,000 of losses that they receive. They can take 75% of that $50,000 and use it against their income they've made in the year they made the investment.
Not just in the year they made the investment. The cool thing is, you take those losses, and if you can't, and you likely won't, I mean, you might have some cash flow, but you're not going to have $50,000 worth of cash flow in the first year unless you found the greatest deal ever. But you get to use the excess losses that you have and carry those forward. So you're going to want to file taxes on behalf of the IRA every year and carry forward those losses. And they really help to build up and ultimately wipe out a huge portion of your taxable income.
Your taxable income unrelated to the IRA itself. The IRA is just a vehicle you're using to invest into the deal. So now the deal goes through its lifetime. The sponsor does the value add business model or any other business model related to the deal. And now they exit the deal. Let's say usually the syndicated deals are 3 to 7 years. Let's say they exit in year 5. Now you're receiving your initial investment back, which is $100,000 plus any capital gains you've made. Let's say you end up doubling your money in 5 years. You receive another $100,000. Walk us through that process. What happens there? Now, you've also used this tax savings along the way as well against your income. So there's benefits there. But talk to us about what happens with that $100,000 of capital gains.
Okay, so if we're saying there's exactly $100,000 of capital gains over a 5-year period, just from what I've seen, you're probably looking at 65 to 75, 80% losses that you can have access to. So you'll be able to use 75% of that, whatever that might be, and that'll carry forward and add up. And then once you have $100,000 of losses, you can use that and apply it to your overall capital gains status. There is recapture involved within an IRA, but it does.
But didn't you use those losses already against your income? Now you can use it against the capital gains as well?
So the only income, the losses stay within the IRA. So you don't have access to use them in your own personal returns.
Okay.
So as long as, I mean, from what I've seen, I've never seen on any deal high enough cash flow that it actually uses up all of the losses that the investment spins off. You might, I mean, if you, for $100,000, you might see $8,000 or $9,000 in cash flow every single year, something around there. But you tend to actually get that many losses each year. So it's going to offset it, and you continue to carry it forward, and it never really gets used in full. So you get to apply whatever is left over by the 5th year. You can apply that towards your capital gains.
Got it. So now Now you received a portion of this $100,000 in profit you've made, the capital gains. You received some of it in cash flow, and you received some of it at the end when the property was sold and divested. So let's say in total, another 100,000 came into your IRA. Does it come and sit in your IRA account? Do you have access to it? What happens there?
Yeah, it goes directly back into your self-directed IRA. So any investment, anything that happens within a self-directed retirement account, it always stays within the IRA. You can't touch it yourself until you turn 59 and a half, and then you have access to the.
Got it. Any advantage in using the Roth IRA for the same strategy we just talked about, for the same model?
Yeah, I mean, it really depends on each person's individual taxation situation, but I'm a huge advocate of Roth accounts. We are kind of in a time where we're at the lowest tax rates we've ever really seen in America. So I'm a big fan of paying the taxes up front, because especially if you're kind of betting on yourself, there's a good chance you might earn more in the future when you ultimately are taking those distributions. So the actual action of investing a Roth versus a traditional, when you actually make the investment, there's no difference. There's still this taxation situation, even though it's a tax deferred account. But it just kind of changes how money flows in and out at the beginning and end.
All right, Josh. And if somebody put a significant amount of money into their self-directed IRA, is there a cap on how much they can invest per year?
No, not at all.
Okay.
Got it. And do you have any data on as far as how much is within the U.S. IRA vehicle currently? Is it just trillions of dollars we're talking about?
Yeah, I think it's around $6 trillion that are in IRAs.
And do you know what portion of that is in equities? What portion alternative investments? We're going to put you under the gun over here, man.
No, that I do not know. I remember seeing something recently, maybe like a half a year ago, and it was below the 1 trillion mark. It was more than you might think, but it's certainly, because like if you think about it, a lot of the funds that are in self-directed retirement accounts, they're going to be used by savvy investors who probably have larger IRAs than the average IRA. So it's a disproportionately small number of IRA holders who are earning a disproportionately large amount of the overall IRA bucket in America. But yeah, it's still a small dent compared to the full IRA.
But the classic advice from financial advisors is open your IRA or Roth IRA, invest it in index funds, and forget about it, right? That's a conventional kind of approach.
Absolutely.
And then Josh, maybe you can share with us some companies, self-directed IRA company custodians.
Yeah, so this is probably a good time to talk about custodial versus checkbook control, because it kind of touches on this.
Yeah, please.
So there's really two different types of self-directed retirement accounts you can open up. And I think they're both good for different types of investors. So it just depends on what you plan on doing. So the first one and the first step for both of them is the exact same. What you ultimately do when you open up a self-directed retirement account is you take your existing IRA or an existing 401k, and then you open up a new self-directed IRA at a custodian, and you roll those funds over into the custodial account. So if you stop right there, that's just called a custodial account. It sits at the custodian. When you want to make an investment, you send them paperwork about the investment details, and they'll run through it and everything. The alternate that you can do is actually taking it a step further. And so I highly suggest using a vendor to help you with all of this if you're using what's called checkbook control. So that first step is still the same. So you would open up that self-directed retirement account at a custodian, but at the same time, the vendor that you've hired, they're actually going to open up an LLC as well. And the IRA itself is going to own that LLC. So you're going to take 100% of the funds that end up in the IRA and invest them into that LLC. So now the LLC is wholly owned by the IRA. Now you actually have direct control over that LLC. You open up a business checking account just as you would for any other business. And you can control your investments from there directly. You don't have to go back to the custodian and say, here are the details, can I process this paperwork? And the benefit of that is if you leave it at the custodian, you're looking at higher fees. So you're looking at they're usually going to be scaled based on how large the account is. So if you have an account that's $750,000, industry average I've seen is about $700 annually that you have to pay in fees. And if you're doing a good job being an investor, you're obviously growing that account. It's getting larger and larger. And so you're actually paying higher and higher and higher fees because they scale progressively with it. So I think it's a little tricky. I don't necessarily think it's the optimal vehicle just because of those higher fees. And when you use a checkbook control account, you actually get a standard, just a flat rate, because there's no administrative detail and burden for the custodian. So they'll typically charge you somewhere in the range of $200 to $300 annually. That's it. It's a flat rate. And you just have to pay like a wire fee every single time that you do a transaction. If it's held at the custodian, when you do that paperwork and you send them details about the deal, you usually have to pay somewhere between $100 and $150 every time to process the paperwork, because they themselves they're going through and there's some manual labor involved on their end. So for those two different accounts, for custodial, I would typically suggest that people who are more actively involved in their investments use those accounts. Those are going to be good for people who plan on maybe flipping. They want to own an Airbnb. They're a little more hands-on, and they maybe want some guidance on, because the custodian can make sure when they're checking all that paperwork, essentially what they're doing is making sure that you're not actively involved in the investment you're making. That's their kind of check. So if you want that kind of backstop, that's really good. If you're just planning on investing as a limited partner in syndications and private equity, I highly suggest going the checkbook control route because it simplifies everything. It's a little more work up front, but it's much more simplified for the life of the entire IRA.
And there's not like a whole bunch more paperwork that the investor has to do on their own that the custodian would have done?
No, not at all. It's just that upfront stuff where you're, instead of just opening an account, you're also opening an LLC. So it kind of doubles the paperwork up front.
Just at the beginning, though.
What was that?
Just at the beginning.
Just at the beginning, yeah. It's nothing too scary, honestly. The overall process to open up a checkbook control account and have it fully funded is in the range of 2 to 4 weeks. It just depends on how fast your custodian acts and how quickly you put the paperwork in. But opening up the actual custodial account itself, you can probably open that and have that funded probably in a week or two.
Interesting, because okay, so those two differences, you can save quite a bit of money every year by just doing the checkbook.
Yeah, absolutely.
Okay. Thanks for the education on that, Josh.
Yeah.
Perfect.
Do you want to get this question through? This is a pretty complex question that you had drafted, Ava.
This is a pretty complex question, Josh. So let me just kind of work through it. So if someone uses their self-directed IRA to invest in real estate syndications structured as a pass-through entity, like an LP or maybe an LLC, I'm
not sure if LLCs are passed through, but let's just keep it going.
Correct me if we're wrong. Pass-through entity, would pay like unrelated debt finance income, the UDFI that we were talking about, on capital gains made at the sale of the property. And what's a percentage roughly for, let's say, $1 million property finance with 70% debt, assuming no distribution? So,
okay, so this is kind of the question I had when I started. I didn't know how bad the impact of UDFI and UBIT was going to be. And a lot of people in the industry kind of treat it as this evil boogeyman, say you should never invest in anything that's leveraged because you have to pay taxes. So I ultimately ended up building what's called a UBIT calculator. I think it's the only one out there because I built it originally for myself. I wanted answers into how extensive and how large of an impact UBIT would have. I won't be able to kind of run through the numbers in my own head. It's extremely complex. It took me like a year to build this thing for the exact example, but I can kind of give you like a rough estimate to what I'm seeing industry average overall. Property level, it's kind of hard to say, but on an individual investment. So if you're investing $100,000 into a deal, and let's say like 40% of the income that comes in is cash flow. So you earn $40,000 in cash flow. And let's say when it sells, you earn $60,000 in capital gains. It's kind of like a rough, typical structure for an opportunity. At that point, what I've seen is the ultimate impact ends up being about 12.1% tax rate. So you typically won't pay any taxes on your cash flow. It's going to be at the time of the capital gains. But ultimately the effective tax rate that I found on average is 12%. Some of them are higher in the 20s. Some of them are lower in the we once had an investment that we offered was like 9% tax on it, but yeah, it kind of ranges based on the different structure of the deal, depends on how large it is, how large the value add of it is, what the debt involved is. There's a bunch of different levers that get pulled.
How involved is the sponsor in this whole process when you have registered funds, when you have custodians involved, when you have obviously a general partner sponsor? How involved are they in this whole process?
Well, so the majority of the work is up front when you're signing your documents. There's kind of two different versions here. And it depends on the type of your account you have. So if you are investing with a custodial account, typically the custodian will want to sign the documents themselves. So as general partners, we typically need to send them the actual private placement memorandum, the subscription agreement, and typically the company operating agreement as well, because they want to review that, make sure there's no controlling parties that are the beneficiary of the IRA. So we send them that, and they sign the documents on their side, and typically we'll send it back to us and we upload it into our portal. So that's the main involvement for a general partner on that side. If you're using a checkbook control account, you'll typically sign the documents yourself. And so we kind of, I think a lot of other syndicators don't really pay too much attention to it, but I keep a close eye on it because I myself am an IRA investor. I would want my stuff buttoned up. So I kind of take a look at how people have signed the document, make sure it's the way it needs to be signed. And sometimes maybe like half the time, honestly, because it is a little tricky getting it done the first time. I'll have them re-sign, just make sure I kind of guide them through the proper way to sign the document. But that's the majority of the handholding and general partner involvement. Outside of that, when it actually comes tax time, what we do is from the property level, we put out a K-1, and that will tell you what your income and your losses are. And that's what you can ultimately use to carry forward losses or file your taxes for your IRA. But yeah, that's generally the only involvement. The only thing you want to look out for when you do invest with an IRA or a 401k in something that's going to give you a K-1 is there's usually like a footnotes page, 2 or 3 pages below. And if you have already invested, you might want to look back and see what I'm talking about. It's usually a footnotes, and it'll explain what the debt situation is on the property, what the straight line depreciation is on the property. It'll give all the different facts and figures for the CPA to be able to calculate what your tax liability is. If it's not there, you need to ask your sponsor for it because the CPA needs to include those numbers. Otherwise, you can't actually calculate your UDFI.
Do you have any stats on what percentage of equity in syndicated deals comes from IRA accounts, or have you, in your experience, because you're focused on helping people use their registered funds, so I'm guessing people coming through your private equity shop might be a higher percentage, but when you're looking at other people's deals,
it's high. I don't want to say exactly who it is because I'm not sure, and they told me in confidence, but you may have mentioned their name earlier in the show. They had said it was 60% of their investors are IRA, and that's honestly roughly, I mean, mine's somewhere between 60 and 70% are retirement investors. But that's kind of why I like to talk about this, because it's an amazingly easy in for a lot of investors. Like it's a little more daunting to put $100,000 into an investment for 5 years if it's your cash and you might need access to that. But if you have $200,000, $300,000 in your IRA and you're not going to be accessing that for another 15, 20, or 30 years, you weren't planning on touching it anyways. So a 5-year deal is not nearly as intimidating for a retirement investor as it is for cash. So I think a lot of people, once they realize what you can do with self-directed retirement accounts, are more inclined to get started through that avenue.
That makes a whole lot of sense.
All right, let's talk about something else here. Obviously, we're based here in Canada. We're running away to the U.S. very soon here, to Florida, from all places. Right. So we're going from extreme left to extreme right. Just joking. But anyhow, we're talking about tax benefits and other items that the U.S. offers. Let's talk about 1031 exchange, which is one of the greatest tax benefits that exists. This idea of rolling over, your profits and deferring your taxes for forever, pretty much. Talk to us. How does a 1031 exchange. Let's talk about, maybe talking about it on the basis of syndicated deals might make it too complicated because it is pretty complicated. But talk to us about our IRA investments, registered fund investments that have been invested into quasi passive deals like owning an Airbnb, but then you divested that deal a few years down the road, you've sold it. Can someone then talk to us about the mechanics of that process? Can they 1031 exchange it? Talk to us about that.
Yeah, it's the exact same in an IRA. So you can 1031 within an IRA. The same rules exist. It's honestly, I'm like halfway embarrassed to mention this. I only learned this about 6 months or a year ago. I've been doing this for 3 or 4 years, and I didn't think it was possible. But yeah, my dad's actually done it with one of his investments through a syndication, because the syndication opted a 1031. But yeah, it's the same process.
Who did that?
My dad.
Oh, your dad. Okay. So your dad is an LP. Okay, cool, man. Awesome.
Yeah, I'm getting him involved in all kinds of stuff.
Awesome.
Oh, good,
awesome.
good stuff. And just so Canadians know, we don't have 1031 exchanges here in Canada.
But we do have another gambit. And the gambit is your primary residence. Any couple of games you make on your primary residence is 100% tax-free. There's no cap. I believe in the US, there's certain caps there. Mm-hmm. So if you bought a property for $1, and then you sold it and it's your primary residence and you sold it for $10 million, that's 100% tax-free. Wow. Even if you built the property yourself and your intent was to buy a piece of land and build the property, any gains made there from the land itself when it converts to the property and then it's sold eventually, it's 100% tax-free. So we do have some benefits on that side.
Yeah.
Is there any limit to how long you have to live in the house as your primary residence?
It's intent. It goes by intent. So right now they're putting restrictions of a minimum of a year, but prior to this was intent. So you could have lived in a house for 3 or 4 years, but if the CRA found out that your intent initially was to sell it because you listed it or you've talked to, they can find proof that your intent was to buy this piece of land and then sell it, then it doesn't matter how long you live there. You're being taxed on it. But if your intent was to buy a piece of land, build a house, and then something tragic happened in your family and you sold it the next day, it's still 100% tax-free because your intent was to live in it, but then out of the circumstance. So I think now they're bringing something in that's at that minimum at 1 year of having to live there. But again, there's the system here in Canada is to basically restrict you from growth, restrict you from gaining. Is 50% tax is California times 10x California here for Canadians. Very difficult. In the US is much more helping you grow, and the system is there to help you grow. Is a capitalistic system, which Canada is a socialist system. So that's where we're running from here.
Jeez, August, it sounds like you sure.
We're running. We're running. So let's keep going through these next questions and stay professional as much as we can. All right. So what would you like to touch on? I think we touched on this.
We touched on a lot of this. Yeah, we're really, thank you so much for describing.
Yeah, let's switch the conversation. I think we got kind of a crash course on registered funds.
Yes.
This life situation happens to you. You have access to these accounts. You're looking to invest. You don't want to go the conventional route. You looked at alternative investments. You find this beautiful, like Ava likes to say, this beautiful investment, which is multifamily syndication. And then now talk to us about you getting more involved, because correct me if I'm wrong, you run a boutique private equity firm. You cherry pick the best sponsors out there to partner with, general partner, co-general partner, or general partner these deals. Talk to us about your journey there, your involvement there. Also I've kind of researched you before the show. I noticed that you're part of some great masterminds in our space. And you seem to have immersed yourself in this space of real estate private equity. Kind of talk to us about that aspect of it.
Yeah, absolutely. And you touched on a great point. The mentorship side of things is really what changed the entire game for me. It's not going to be for everybody, but for me, I didn't come from a family that had any real estate experience. I didn't have actually any real estate background before I began 5 years ago. So I knew that if I wanted to purchase multifamily properties, I'd be, going to brokers and giving them calls and everything. And I would have no track record and no basis, and they likely would not be sending me their best deals. So I ultimately joined a mentorship, which was Think Multifamily. I'm still a part of it. The benefit from that kind of a mentorship was that I got access.
We missed you in Dallas, man. We missed you at one of their recent events.
Oh, really?
All right, keep going.
There
brother.
next week, or 2 weeks from now.
Yes, I know that happened already, but keep going.
Yeah. So essentially, I got access to my mentor's name is Mark Kenny. I had access to his track record as well as other sponsors within the group. And when you partner together, you get the benefit of somebody else having that background and experience. So you have access to better deals. You also have access to their capital, their liquidity and their net worth. Those are things you need for a large commercial loan.
That doesn't happen normally. Most mentorship programs and most groups don't offer this. Mark Kenny is a special one. He literally steps in and takes the bullet for his people. So we love the guy. We love what him and his wife Tamil have created. So just want to touch on that. So that's not the norm, brother. That's not the norm for.
Yeah, I didn't know that because that's all I've ever known. It's a huge benefit. It's nice because I was able to team up and you hear this so often, like multifamily is a team sport, but it really is. I started off thinking I was going to be looking for deals. And realized it was a little more difficult for my skill set than I thought. And once I realized that I had all this knowledge, one of the other members of Think Multifamily actually pointed out, and I'd given a presentation, one like brunch that we hosted in Denver, gave a presentation on retirement accounts, and he said, "Hey, you got a lot of knowledge around this. You could probably raise capital, teaching people about this." And so I ultimately moved mostly towards capital raising and providing earnest money and kind of being on the capital stack side of things more than just finding the deals. Found it was more aligned with my skill set, and also I have kind of a deep desire for teaching and educating people. So it was nice. I felt like not only was I changing people's lives with the investments we were offering, but also I was changing people's lives with opening their eyes for what they can do, whether they're investing with us or not. It, hopefully alters their future.
Of course, and it's a very important and crucial part of the business of the private equity space, be it real estate or others, is the capital side of things, and you're a fiduciary to your clients, to your investors, their partners. Again, like I mentioned earlier, you're cherry picking the best deals to put your name and reputation on the line. So it's definitely an important and crucial kind of business to be in. Talk to us about your long-term plans. Is it the plan? And I've seen people be in your kind of spot, having investors, partnering with different groups to take down larger deals. And keep in mind, we talk about this concept of partnering with sponsors. This happens on the institutional side as well. Yes. For example, Blackstone partners with a lot of different sponsors for a lot of deals they do. The Canadian Pension Fund partnered with Greystar. So this collaboration between the capital partners and the sponsors, it's very common space. So don't see this just happening on their retail level. But what are your long-term plans now? Kind of we're getting a little bit more into what you've been up to. Is the plan to be continuously running a boutique private equity firm? Is it to get involved on the more active side, if it's on the acquisitions and asset management? Our company has gone through that process, that journey as well. Talk to us about your long-term plans and what are you planning to do?
Yeah, so ultimately, and you might imagine this because having created the UBIT calculator, it's in Excel. It was a huge undertaking. My background is in analytics, so I have a lot more of a connection, and I feel more in tune with the numbers side of things. So I do want to move back into finding deals and acquiring them now that I have a track record myself and can speak to brokers with knowledge and ease. So ultimately, what my vision for my company is, I want to get to the level where I can confidently raise somewhere between $3 and $5 million. Then I can move towards operations and deal acquisition, add that piece, kind of focus on that once I have the system up and running that allows us to raise those types of funds. Because I'd like to find my own deals and then partner with one or two other people. I don't want to work with huge teams. I'd like to partner with one or two people that I know and operate on a consistent basis, know how they work, and go out and find our own deals going forward. Because we're kind of focused on retirement investing, I'd also like to, begin offering some sort of self-directed retirement products. I recently, this is kind of a little off topic. I recently went through the process of opening up a custodial account for my daughter. She's turning 2 next week, and I wanted to get her involved in real estate with her custodial account, and I opened it up at Schwab, and it was next to impossible to actually free those funds up and move those into anything that was not offered at Schwab, like a ETF or index fund or mutual fund, whatever it might be. I had to go through this whole process on the phone with all kinds of people just to get them to cut me a check, just so I could give it to my friend in Boston who was going to flip a property, and I wanted to have my daughter lend to him. So it took forever. So I would actually like to offer some sort of a custodial product.
Amazing.
Offering, people who are involved in real estate, that they can, work towards their kids' future and save for college that way.
I think you've really answered it yourself. You're talking about sponsors telling you 60% of the equity they've raised comes from IRA. You seem to be becoming an expert into this space. So you definitely have a bright future. Let's touch on one more topic here before the next segment of our show. We've had you here for a long time today. Forgive us. We really enjoyed talking with you. Let's talk about the economy. Let's talk about the real estate market. Earlier, I talked to you about being the fiduciary to your investors. What are you seeing currently? Kind of my perspective is you got the rapid increase of interest rates by the Fed to combat inflation. You have a lot of commercial real estate holders, the institutional type of commercial real estate holders that have long-term debt, fixed debt on their deals. They're not really selling those deals. The deals that are on the market some are potentially distressed. Some of them are the price difference between what the sellers are asking and the buyers are willing to pay, and that's because of where the debt market is at is not really there. Obviously, people are asking for 4% to 5% cap rates for their deals, but the interest rates are at 5.5%. That arbitrage really doesn't exist. It's kind of that negative spread that exists there. What are you seeing? Are deals still available in this market? Is there certain check marks that you're looking for? Are you looking for assumable loans? Are you looking for long-term fixed debt? What interests you right now to even look at a deal for your investors?
Yeah, right now, deal hunting, this is March 2023. It's a little easier for deal hunting than when they first started bumping rates up. There was a lot more volatility in the market. Lending terms were getting pulled out underneath people's feet at the last second. So there's a lot more unsuredness. It was a lot scarier, I think, kind of like late summer last year. Right now, I think it's just a little more consistent. You know what you're dealing with. We know we're dealing with maybe 1 or 2 more rate hikes. It could be more than that. It could be less than that. I don't know, but it's at least a known quantity, a known fact that we know what we're dealing with. So there's not as much volatility in the lending markets. But yeah, you touched on a great point that sellers kind of aren't in the same place as buyers. So we're seeing product come to market, but not nearly as much because a lot of sellers don't really want to come to market. They don't want to be forced, but they will be at some point here because of the high interest rates. But there's just as many buyers as always waiting for those deals. But I saw CBRE release their cap rate study, and between the first quarter and second quarter of the year, they've actually seen cap rates jump. I looked at the list for multifamily. It was roughly 75 basis points to a full percent from where they were just in December.
Wow.
So it's a huge jump, and we're seeing property values kind of come back down to earth a little bit. So I'm all eyes when, we have a new opportunity. I definitely want to look for things in terms of like the actual debt we're looking at. I think at the beginning of this, I would have liked fixed debt when we were kind of in that 4 to 5% range. Would have been a lot more comfortable with it. But now that we kind of know roughly where the peak might be, and it might, it's not, I don't have a magic 8 ball. It might not be the peak, but what we're seeing, I'm not sure I'd really want fixed debt right now because you're kind of locked into a higher rate for a longer time. not that I would say I would be totally against it, but I would maybe look more at bridge products if they're available that could maybe float down as long as the rate caps are not nearly as high of a price as they were last year. So if you can afford a rate cap, if you can afford a way to kind of hedge the downside, I think there's a lot of good debt options out there right now.
Couple of more quick questions. What type of business model are you looking at? Core plus, value add? Are you looking for newer deals that don't need a lot of any renovations? Are you looking at deals for value add where the sponsor can go in and do forced appreciation? Like what kind of excites you? What type of business model?
Yeah, I mean, what I kind of describe to brokers is my buy window is really like A and B class properties. We own a few C class, and I'm trying to kind of move away from that, not just from the operation side of things, but I'm also finding that investors aren't, at least for retirement investors, maybe they're not as jazzed about a deeper value add opportunity.
And the pitch deck looks much nicer when you have an A class asset with all those beautiful pools and stuff.
That's true.
Yeah, it's much easier to put together a pitch deck when the property looks really nice. And I've seen the difference. We have 4 properties in the Sarasota area, and the response for those is a lot stronger than when we have like a C-class property that we just recently, when we acquired one. It's a phenomenal deal, but it had mansard roofing. And those are the roofs, if you're not familiar with it, that droop down and they come halfway down the siding. And they're it was popular for like 5 years in the 60s. And it looks atrocious. It's like one of the ugliest properties, but it's built well, and it actually held together nicely. It was built in the 80s, but still had that style. But there wasn't as much interest. I noticed that investors they like having an asset they can turn to their friends and say, "Hey, this is what I've invested in," and there's just more confidence maybe in the debt, the risk adjusted assets as well.
Looks matter, definitely.
Yeah,
I mean,
look at beautiful resort style.
Absolutely. I mean, look at our beards, all right? Looks
yes,
matter.
yes.
Last question: markets. What markets are you looking at? Obviously, we're very bullish on Florida. We're physically moving there. You talked about Sarasota being in Southwest Florida. What markets are you looking at? Are you not looking at any particular markets? For example, we look at Phoenix with the overbuilding, the cap rates, the rents being dropping 7%, the decline in rents. I mean, I'm sure there's great deals still in Phoenix, so I'm nothing bad about Phoenix deals. But is there markets you're looking at? Is there markets you're staying away from?
Yeah, I mean, specifically, I really like the Florida markets a lot, especially Southwest Florida. When we bought 4 properties consecutively in about a 1.5 year span, and we did so because it was ranked the #1 rent growth market in the entire country. When everyone was seeing high rent growth, they were seeing the most because there's just such an interest in moving to that area of the country. It's a lower cost of living, and so the demographic shifts that's going on there is unbelievable. But the only downside is the volatility in the insurance market. When the hurricane passed through last year, we saw our insurance rates go up. I think the renewal was going to be 3 times what we were paying because our carrier didn't want to. They stopped writing new policies in the entire state, and they didn't want to continue doing business in Florida. So they were actually, jacking up people's rates and saying, "Hey, if you want to stay on us, this is your new rate." So we actually had to transition we looked at alternate opportunities, and we transitioned all of our properties into a different property manager who had an umbrella policy across all of their properties that they have. So that actually lowered our insurance rate. So we had to find something to actually continue operating the property. There's less volatility right now, and I think as things stabilize and we kind of understand the impacts possibly of more climate change, that we're going to see more assuredness in the insurance market. But other than that, huge fan of Georgia. We got some properties in Atlanta. I live in Charlotte. I would love to buy every property I see here. It's an amazing market. All of North Carolina, but yeah, much of the Sun Belt is where we're at, but the Southeast is where we really seem to be finding the best properties for our profile.
Nice.
Awesome, man. Really appreciate it. Thank you so much. Again, we kept you for a long time, answering all our questions eloquently.
And you're not done yet.
Yes. Oh, yeah. There's the second segment of our show. Let's get going, Ava.
Okay, Josh, the 10 championship rounds to financial freedom. There's 10 questions, so whatever comes to top of mind. Are you ready?
Yeah.
Okay, let's do this. First question. Who is the most influential person in your life?
The most influential person in my life, I guess I will say my wife. Yeah. She's my sounding board. And as an entrepreneur, it's, as someone who's very analytical, I have a maybe different approach and a different mindset towards a lot of stuff. So she's very extroverted. I'm introverted. She has a different perspective. So it really allows me to kind of see what other people might view whenever I have an idea.
That's the most common answer we get here, and it's obvious that most of our guests are under duress by their wives.
Oh, August, who's the most influential person in your life?
Just kidding. Don't put me under the gun on my own show. Come on, wife.
Okay, Josh, here we go. What's the number one book you'd recommend?
Number one book I'd recommend. I like to talk about this book called Blue Ocean Strategies. It's really cool because it kind of talks about the difference between what's a red ocean and a blue ocean. And a red ocean is a product like, let's say, toothpaste. There's no new invention for the toothpaste. You can't come up with a new thing. It's maybe just different flavors and different branding and marketing. So it's a race to the bottom. Whoever can provide the lowest cost for their product and charge the most for it, but they're all doing the exact same thing. A blue ocean is when you invent your own product and it's your own actual niche. So the best example that I gave was Cirque du Soleil. So Cirque du Soleil is a mix of circus, opera, ballet, performative arts. And so it's actually bringing in multiple different audiences who wouldn't otherwise have, I might not go to a ballet, but I would go to Cirque du Soleil because I'm interested maybe in circus and performing arts. So you're actually bringing in multiple audiences into one area and you're able to kind of build your own blue ocean that's untapped and there's not as much blood in the water.
Awesome. I think Peter Thiel in his book 0 to 1 also talks about that concept of there's never going to be another Facebook, but talks about kind of building companies and what have you. Great.
Okay, next question, Josh. If you had the opportunity to travel back in time, what advice would you give your younger self?
I'd probably get off the stock market faster. It did well for me, but I'm not like an emotional investor and I'm pretty level-headed, but I feel like I fit more with real estate. I like the sounding board of other people and kind of talking through an investment as opposed to doing my own analysis and relying on my own analysis of what I choose to invest in and maybe being burned by, I've been burned a couple of times by hedge funds that have tanked a investment I was in and not really happy with that. So I would just move to alternate funds or investments earlier.
Okay, that's really nice. Now, this leads to the next question. What's the best investment you've ever made?
Best investment I ever made was a property we had north of Atlanta in Dalton, Georgia. We invested our IRAs in it. It was supposed to be a 5-year deal. It ended up selling, I think, it was like 14 months, and it resulted in a 76% IRR on the deal.
Wow. Okay.
Never going to replicate that.
Yeah, no, that's a dive in the rough. Okay, now what's the worst investment you've ever made, and what lessons did you learn from it?
So the worst investment was that one I had kind of mentioned earlier was I invested in a biotech company that had a strong promise of developing a cancer drug. And yeah, there was a lot of hype around it, but they were kind of also inflating their own results and everything. And it didn't get approved. And then on top of that, there was just a lot of manipulation both on the upswing and on the downswing from hedge funds. So it was very difficult to find the right time to pull out. It was not a lot of fun.
Okay. Next question. How much would you need in the bank to retire today? What's your number?
Yeah, I don't really have an exact number. My life consists more around how much time I have available to myself. I don't need to, in my mind, I don't need to make a ton of money. I really just want to make enough money that allows me to kind of be there for, see my daughter's milestones and whoever my next kid ends up being. I want to be around all the time. That's the coolest part about my job is I'm there. So whatever gets me to that point, somewhere around $100,000 or $150,000 a year. So whatever 4% of that is, $3-4 million. I don't know.
Nice. I like that answer. Okay. If you could have dinner with someone dead or alive, who would it be?
I would probably have dinner with Alex Ramosi. I haven't really I've been paying attention to his stuff a little more in the last few months, and just an amazing mind in terms of his mindset, the way he thinks about things. Read his book, $1 million, was it $100 million offers? It was amazing. It's the way he just kind of like conceptualized everything around business and entrepreneurship. It's really unique and very digestible takes. So I would highly suggest checking him out for any listener who hasn't actually seen him. But yeah, Alex Hormozi, cool dude.
He's on my feed my YouTube feed all the time. Yeah, interesting about kind of who would you have dinner with, and Josh picking Alex Hormozi. I think he ate at what is that well-known burrito place in the U.S. Like one most famous kind of burrito Mexican place. What is it called? Anyways, he ate at that place for like 2 years straight.
Yeah.
Oh, Chipotle. Yeah.
Chipotle. Yeah.
Yeah,
he did.
You went there every day for lunch?
Yeah, every day for all of his meals. He ate there for like an extended period of time.
Oh, really?
I did Chipotle every day for a month. I think it was a month or two. There was some sort of deal they were running, and you don't feel good. I don't know how he did it.
Oh, interesting. Okay.
Right.
Okay, never heard of it. Okay, next question, Josh. If you weren't doing what you're doing today, what would you be doing now?
I would probably be like a ski instructor or do ski patrol on a mountain. We were living in Denver, Colorado for 6 or 7 years, and I really felt at home in the mountains. Skiing's my favorite thing. It's one of my whys. So being able to kind of help people enjoy it and enjoy it myself, and maybe make the mountain fun and safe for everybody else while getting paid to do it would be good.
Nice. We got to do Whistler at some point.
Yeah.
And then maybe before you guys go skiing, you could teach me how to ski.
You know the basics.
I know how to ski, but I want to be better. Okay, this is my favorite question. Book smarts or street smarts?
Yeah, it's tricky. I would probably, the more and more I am in business, I'd probably say street smarts. The more and more I'm learning, it's a lot of it's about mindset and understanding of yourself and the environment around you and how to deal with it. Not so much just the knowledge you have. I've found myself at times being stuck by analysis paralysis. So there's a level at which the book smarts end up hindering your ability to perform.
Right on. Last question, Josh. If you had $1 million in cash and you had to make one investment today, what would it be?
One investment. I would. I'd probably. I don't know. We actually have a deal right now, and I'm not trying to advertise or anything. I won't even say much about it. It's 506C, so I can talk about it. But it's development.
Talk away, brother. Talk away.
Yeah, please.
Depends when this airs, but it's a development project here in Charlotte. So
I saw it on your LinkedIn. I believe.
Yeah, we're building 29 townhomes, and it's my first jump into a different asset class. But I really like, we were talking about this whole economic situation, and there's a lot of not really people know what's going to be happening. And so what I like about a development project right now is it takes advantage. In Charlotte, there's so much development going on, so many people moving here. We need 45,000 new new units and 20 something thousand new homes. And that's numbers from last year. We don't even have accurate numbers right now. So there's so much demand. So I would invest in a market that had that demand, but it was an investment that it bridged me to the other side of all this economic uncertainty. So I'm all for multifamily and everything, but if I had $1 million for anything, it would be something that got me to the other side of all of this economic hoopla.
Nice.
Right on, Josh. What's the best way people can reach you?
Yeah, you can find us at wall2main.com. And if you're interested in that UBIT calculator I was talking about, you can find it at UBIT calc.com.
That's awesome,
man.
People
really
are going to be signing up for that, I'm sure.
I think we said last question 20 times, but
that was you.
Thanks so much for your time, man.
Thanks for dropping a lot of gold on this interview today, Josh.
Yeah, happy to be here. Thanks.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.